Hi there, this is Dr. Sami Garas, and in this video, we will close off a very important phase in auditing, which is the field work. If you remember, our discussion started in this course by having an auditor trying to do an audit for a client. We say the auditor has to be aware of the auditing standards. The auditor should have code of ethics to follow. And the auditor should start to build up good relationship with the client to understand the client before the auditor is doing the real audit. And once the auditor get a good information about the client, he has to assess the internal control to see if there is any risks or material misstatement and make sure that the client is making good control on those risks. And then the auditor has to collect evidence about his audit and try to get the evidence based on a sample. And because of that, we were discussing all the different ways, whether statistical or non-statistical sampling, to help the auditor collect good evidence. Once the auditor make a decision about the amount of evidence and the sample, the auditor will start doing the real audit. So first, the auditor will audit the cash and financial instruments, then the revenue cycle, then inventory cycle, and then he will move on to payroll cycle, investment cycle, and other cycles. In this course, because it's short, I discussed only 3 cycles, but in real life audit, they are more than the 3 life cycles. And in this chapter, we will discuss 2 different issues. First, the finalization of the audit process in the client's office, and then the amount of documents the auditor has to accumulate before he goes back to his office to sit with the partner audit report. So the key points that we are going to discuss in this video, first of all, we will talk about contingencies. We will explain the definition of contingency and the way of recording the contingency in the financial statements. Then the letter that the auditor should get from the lawyer of the company, and any subsequent event that might happen after the audit part. Then the auditor has to get a letter from the management called management representation letter. And I need you to remember that the auditor gets 2 letters from the management. One at the beginning of the audit, we call it engagement letter. The other one at the end of the audit, we call it representation letter. So there are 2 different letters the auditor should get from the manager. Then the auditor has to accumulate the evidence, take it to his office, sit with the audit partner to evaluate the audit process, and then come up with guideline for the audit report, which he has to discuss with the audit committee. And this is what we mean by communication with audit committee. So with that in mind, let us discuss contingencies. What are the contingencies? These are possible payment. They might be made during the coming year, or impairment in assets. And for the possible payments, like for example, some litigation might happen, or dispute in tax, or loss of accounts receivable or notes receivable, those are future payment that might be made during the coming year. Should we disclose them as a current liability of the financial statements in this year or not? This is what we mean by contingency. The other point is the impairment of goodwill. If company A is acquiring company B, and company A is paying more than the fair value of company B, the extra amount, we call it goodwill. This goodwill might be reduced or fluctuated during the future year for the reduction in the value of the company. And this is also contingency, because reducing the asset amount definitely affects the financial statements. So here, those 2 items of possible liability or asset impairment needs to be addressed in the contingency part. The issue is that we should discuss the probability of those 2 items to happen. The first one, it's the probability, as I said, whether we have high probability or low probability. And based on the high probability, we make a decision to include or exclude those contingencies. The second is the amount that we need to do based on the future event. For example, litigation, if the court made a decision, then we will make the payment. So this is the event. Or if the IRS send us of our amount. So this is future event. And when I talk about IRS, I don't talk about regular payment dispute that might arise between the client and the IRS. So in this table, I am showing the probability and the approximate amount, and based on that, we make a decision about treatment of those contingencies is the financial statements. So first of all, if the probability is very low, like maybe 5% or 10%, what shall we do about the contingency? We say ignore them. We don't disclose them. How about the probability is high, like 90%, but the amount is not determinable. So when I talk about the determination here, I talk about the amount. We don't know how much is the amount, but we know like 90%, we will pay something. So here we record it in the financial notes, in the financial statement. Third, if the probability is high and the amount is approximated, we know how much we will pay. Then we have to record it in the financial statement as adjustment. Finally, if the probability is high, but the amount is not determined, we record it in the financial note. So those are the contingencies situations. And remember, the two key points that we need to consider about any contingent amount is the probability and the approximation of the amount. How we disclose them? We disclose them like in this paragraph. So I encourage you to stop the video now. Take a minute, read the paragraph that should be included in the financial statements to disclose the contingencies. And good example of the contingencies, as I said, it could be litigation amount, it could be dispute amount between the company and the IRS, it could be loss of notes receivable or discounted. It means we liquidate the notes receivable at a lower value, or guarantee of obligation to others, or finally, loss of an amount in the letter of credit. So if there is unused amount in the letter of credit that might be lost, this will be a contingency. So what shall we do from our side as auditor? Number one, we need to check our files. So before we raise any issue, we need to read our documentation to get more information about the contingency, and then take our concerns, our doubts, and go to the client management and ask them about the contingency. Not only that, we can read the minutes of the board of directors and shareholders, which can give us good hints about the audit procedures. And then we can see if there is any tax report that mentions litigation between the IRS and the company. We should review the current and previous tax reports. And finally, we check the letter of credit for any information about the unused amount. So with that in mind, I made exercise that you can see it on Blackboard. Please stop the video here, go to Blackboard, get the exercise, which has 6 multiple choice, go through them based on what I discussed in the lecture here, try to get the answer, and once you finish, come back to the video to check your answers. And here are the answers for the first exercise. So remember the first point we said, it's the contingency, possible liability, or impairment of assets, and how the auditor should address it. The second one, the attorney's letter. The attorney's letter, it's based on a request that is usually made by the auditor to the lawyer of the company, asking about any litigation that the auditor is not aware of. So it's a procedure to evaluate any litigation or claims that the auditor doesn't know, and if this claim or this litigation or this violation is against the securities law, the auditor has to be aware of that one. Why? Because the company, especially the public company, they have to submit a copy of their financial statements to the SEC, and the auditor has to include any kind of disputes or violation for the securities law in the financial statements. If the lawyer refuses to give the auditor the answer, then the auditor is free to change up the opinion on the financial statement, either qualified or disclaimer, which will raise a big question mark about the financial statements of the client. However, if the information is confidential, the auditor doesn't have, sorry, the lawyer doesn't have to answer the audit. And here is a sample of the audit, the request that the client has to send to the lawyer. So the auditor here has to mention the lawyer's name, and then the auditor will tell the lawyer all the litigations that he is aware of and his evaluation to the litigations. And the auditor will ask the lawyer if there is any claim or possible claim that might need to be prescribed, or if he has any evaluation for those litigation, and if there is any other litigation that the auditor doesn't know. And the auditor send this official request in writing to the lawyer, and the lawyer has to answer back. I also developed another short exercise that has 5 multiple choice. Please go back to Blackboard, check the exercises, go through them, and come back to the video to check your answers. And here is the answer. As you can see, there are 6 questions talking about the lawyer's letter to the auditor. The last point in this lecture is the subsequent event. What do we mean by subsequent event? Some events might happen during the audit time or after the audit time, but before the release of the audit report or after the audit report. So to make it easy for you, I made it in this figure so you can visualize the subsequent period and the subsequent event. I assume if the financial year of the client starts in January 1st and it ends in December 31st, the auditor usually comes during this period to the client to make the field work. And then once the auditor complete his field work, he will go to the office to work on the audit report and submit. So this date, we call it the balance sheet date. This date, we call it the field work completion date. And this period where the auditor can come at any time to discuss the financial statements with the audit committee and then release the audit report. So here is the evidence that the auditor has to collect. If the auditor find any subsequent event starting from here, the balance sheet date, until the release of the audit report, the auditor has to collect evidence about this event. If the event happens after the release of the audit report, the auditor doesn't need to get an evidence, but he has to disclose it to the public. So before the completion date, if the subsequent event happens, the auditor has to make audit procedures and disclose this event in the financial statements. If the subsequent event happened after the completion date, but before the release of the audit report, here we make dual date audit report. So we make audit report with 2 different dates. If the subsequent event happened after the release of the audit report, then the auditor has to issue another report called subsequent discovery of facts. So this is what we mean by subsequent events. And the procedure in the subsequent event, first of all, we should look for the subsequent event in the management representation letter. We can also ask the CEO or the CFO, the executive team, about those events. Check the board of directors meeting or the shareholders meeting, and then ask the lawyer of the client if he is aware of the subsequent event. Check the financial statements to see if there is any hint about the subsequent event. The subsequent event can be classified into two types for their disclosure in the financial statements. The first one, if the event happened at the balance sheet date, which means end of December, we have to adjust the financial statements. And good example for that, the loss of one of the accounts receivable. If one of the accounts receivable became uncollectible, we have to disclose it in the financial statements, or a litigation that has been settled before the balance sheet date. But if the event happened after the balance sheet date and doesn't require adjustment, then we put it in category 2. We need to disclose it in the financial statement, but we don't need to make adjustment. Disclosure, it means we put it in the financial notes without the adjustment. And then we prepare pro forma financial statement. Then, good example for that, it could be sale of bond or capital stock, purchase of business, settlement of litigation, or loss of plant or inventory. And this is what we mean by subsequent event. In the third exercise, I made it in a Word format. It's not multiple choice. There are different scenarios that can examine your understanding about subsequent event by asking you how the event will be recorded and what are the overstatement or understatement if this event is not recorded. I strongly encourage you to take a few minutes, read the example, try to make the answer, and then come to the video to check the answers. And let me explain here one of the situations. Here it says the company did not include an accrual for bonuses that should be paid for the year 2020, but it was paid in March 2021. What will happen if we didn't record this bonus due in 2020? The amount is $125,000. If we don't record it, then two things will happen. First, our current liability will be understated because the bonus is a liability on the company. If we didn't include it, it means our liability are understated. And because it's expense, so if we didn't include it, it means our income was overstated. So this is what we mean by that example. Again, please take a minute, go to the Blackboard, download the exercise, work on it, and come back to check your answers. Here is the second situation for the equipment. Here is the third situation about the accounts receivable. Here, the fourth situation. The fifth situation. And the fifth situation, it's very interesting because the marketing expense of 43 incorrectly recorded as cost of goods sold. Both marketing expense and cost of goods sold are included in the income tax, or sorry, the income statement. So if one was understated and the one overstated, the final result will be 0. So honestly, I put 43, but I didn't put anything here because if we put plus 43 and minus 43 in the income statement, which means 0. And this is the reason you might see this one blank. Okay. The last one, the company received a new computer in January. So here, because everything happened in January, we don't need to record it in the prior year. Okay. So this is the final result for all the situations in exercise 3. Thank you so much. And I hope you find this video useful. And I will continue the discussion about the audit operation in the next video. Thank you. Bye-bye.